Hello and welcome to Your Business, Your Wealth. I am Paul Adams. I'm the founder and CEO of Sound Financial Group, and I'm so glad you could join us today. But who I'm also very glad could join us? The man that is the lime LaCroix to my otherwise gin and soda, Cory Shepard. So glad you could be here today.
Are you sure it's not I'm the lime to your strawberry? Because you do
Maybe
like it a little more on the fruity side.
it could be. I mean, frankly, LaCroix all tastes like maybe a watermelon truck drove near a bunch of seltzer water
Right.
and like sneezed. And that is why it just has a hint of that taste. But I'm pretty psyched about our episode today because we get to talk a little bit about this area of insurance that most people have heard about, have never actually seen, and we get to have an expert on the show. So, yeah, I mean, for all of you listening today, I mean, here you are jumping outside the regular financial media. You're working to get some really good independent thinking about money, all thinking that's meant to help you better design and build a good life. And this one's going to do that, but we're also going to have some fun because we actually have somebody with us who is an expert in an area of insurance called surplus lines, also known to many of you as protection from Lloyd's of London. That's what most people are most familiar with. They're not familiar with this term called surplus lines, which he's going to explain more here in just a moment. But his name's Robert Clark. He is the regional vice president for Petersen International, who is the largest, what's called a cover writer of surplus lines of Lloyd's of London here in the United States. We are so excited to have you. Robert, welcome to Your Business, Your Wealth.
Thank you so much. I'm just really glad I wasn't introduced as another flavor of LaCroix.
Not yet. Maybe on your next time you come on the show.
That's right.
Really excited to be here. Thank you, guys.
That's actually our first question. If you were a flavor of LaCroix, I'm only kidding.
Okay.
So, Cory, why don't you just kick us off, like just digging into orienting everybody to this whole surplus lines distinction?
Well, we could, if you're into National Treasure or the Da Vinci Code, we're getting into a realm of ancient societies and mysterious groups of very powerful people. Robert, can you give us a little bit of the background of Lloyd's of London, just their history, what Petersen is, and what it means to be a surplus lines cover holder?
I think if I give you a pretty detailed answer on all of that, I might fill up our episode here. So I'll try and keep it short.
Well, very little detail, please. Yeah.
Yeah, you got it. You got it. So back in 1688, it was a Tuesday. I'm kidding. But literally back in the 1600s.
1 in 7 chance it was a Tuesday.
I like those odds. Not really. Back in the 1600s, a lot of the maritime, like cargo ship owners, all got together and started making agreements that if someone's ship went down, the other 3 or 4 partners would help fund to buy that person a new ship. And they all made an agreement that if for anyone in the group that lost their ship, the remaining partners would basically buy them out and rebuild it. So that's where the insurance lines started back, like I said, the 1600s. Now, fast forward to where we are today, there's all these different divisions. There's about 100 different syndicates within Lloyd's. So you have all these different insurance groups, and I'll spare you the details on what the difference between the syndicates and the brokers and the cover holders and all that. But essentially, to write Lloyd's of London coverage here in the United States, you have to have a cover holder status if you want power of the pen to be able to write in the domestically. And so that's where Petersen comes into play. Back in the 70s, they were sourcing a lot of the insurance coverage that we do today through 5-6 different carriers. And at claim time for a client, one, you're filling out 6 different applications.
Yeah.
And then at claim time, not only are you filing 6 different claims, but you have 6 different claims analysts. And so some say yes, some say no, some are plausible, and it just got very convoluted. And so that's originally why our founder went to Lloyd's of London to try and see if he could get contracts to write these insurance risks.
Wow. So this brings me, all kinds of questions, but a very serious one to start us off. What is the craziest thing you have heard Lloyd's of London insuring? Because they have a reputation that they'll insure anything. If there's a risk, they just might take it. So what comes to mind?
Yeah, and that's absolutely right. I'm always afraid of this question because I don't want to cross any lines, but I'll just say that one was a male actor. He performs with no clothes on and with other co-stars being many female models and actresses. So he was an adult entertainer on film, and we covered. We didn't film. We covered one of his prized possessions.
I see. I see.
We may have crossed into our first explicit episode.
We may have to rate this one.
I thought for sure it would be when we had like David Goggins on, but nope. Robert crossed the line for us. So literally though, movie stars, actors, actresses will cover a particular part of their body for how much money?
I mean, it all depends on their income. That's how they justify it. Here's kind of the weird thing, and this is the dirty little secret within Lloyd's. Every time we get one of these requests for body part only coverage, we always tell the client and the agent it is the same exact price to insure their entire body.
Oh.
So they're not getting any discount.
A model with beautiful legs or maybe one of these guys that's just, jacked that you see on Instagram, or it could be an athlete, right? That'd be like my ability to do this one thing. And you guys let them know, like, nope, we just insure all the things because it's the same risk.
Exactly. And so we tell them, but it's really more of a publicity play. We have a lot of musicians that want to insure their hands and their fingers to say that, I'm a guitarist and my hands are insured for $10 million, but they should have just bought the policy for their entire body.
Wow. And what one, never occurred to me that could be the case. And two, that Lloyd's has such a strong brand that I've seen those press releases. I remember one, I don't know why I remember specifically where I was. I was in the parking lot of a Wendy's when I heard it come over the radio. And this is probably 18 years ago. And it was something about J-Lo insuring her tuchus specifically for like $30 million or something ridiculous with Lloyd's of London, which I would imagine probably works out pretty well for Petersen and the publicity as well. But it is funny how people, and I think this is one of those things that could be a takeaway for a lot of people listening, is where do people make a decision that might be a bit vain and not be the most prudent?
Yeah, those tuchus contracts are really picking up over the years.
Right. Are they really? I think that is this may be the best episode we've ever had. Sorry, Cory. I just had to give the color commentary.
I'm enjoying it too. So we'll get to some things that apply directly to our clients' lives in just a second. Promise. Stay with us, folks. In that vein, even if it's a very normal kind of thing, some people are willing to pay a lot to protect prized possessions.
Yep.
What's the highest amount someone's been willing to pay to protect something, the amount of premium?
Gosh, you're talking about body part only coverage?
If you knew that number, that'd be fun, but anything really.
Any premium? I would say the largest premium that I've seen would be $6.8 million
per year.
And what was being covered?
A professional athlete.
Professional athlete earning some multiples of that, I would imagine.
Right. Very large contract. Yeah.
Well,
which makes perfect sense if they'd be willing to pay that small slice to keep, we'll just call it potentially hundreds of millions if you wrap in their contract and their endorsement deals and all those things that could go away if they're not playing anymore.
Yep, absolutely.
Well, so let's go back to just a regular everyday listener listening to the show right now. Of course, you have this surplus lines, a little bit more exotic in the way the coverage works. And yet, why do you think that high income earning executive or the entrepreneur listening to our podcast right now that's making $300,000 to $2 million a year, why is it they should be protecting their income against sickness or injury that would prevent them from being able to earn?
So interesting, really interesting correlation that not too many people think of when they think of, I'm an executive or I'm a business owner. If you're making $500,000 a year, so many see that as, well, I'm only making 500,000. A lot of these professionals or athletes or entertainers that make way more than me, they're the ones that really need the insurance. But they're not really thinking about the second dimension of income. And that's where I talk about the sustainability, the length of their career that they're planning to earn that money. At the end of the day, our executives, our business owners, our doctors, they are compensated pretty evenly with a lot of these athletes. It's just that for an athlete, they're earning that same 10 or $20 million in career earnings in a much shorter window, right? So instead of 30 years of working and running the business, they're earning that same amount of money in 7 or 8 years. And so we see it a lot more in the athletes buying these policies because they're really concerned about that short window of time that they need to be healthy. But here all along, these executives and business owners are earning that same amount of money just over the course of 30 years.
So they've got a bucket. They've got the same size bucket as those athletes. Just the bucket is a lot closer in view for those athletes. So I've got doctors are one that's kind of the opposite order, or they have a lot of expenses up front, and so they come out of school and start to earn money and have a sense that they want to protect their income. I mean, you think about a cardiologist comes out of fellowship, maybe they're making $450 depending on what area of practice they're in, and life's great, but every other doctor that's around them is saying, hey, you need disability insurance because they've got that culture. Where do you think the disconnect is that a business executive or an entrepreneur who are making much the same or even more, they're not in that culture with each other? They don't have that black and white approach of we've got to protect our income.
Yep, absolutely. It's two completely different cultures like you're talking about. One, I think what's really important or relevant for doctors is that they see a lot of these disabilities every day, right? And most really overestimate what a disability really is. Everyone's looking for a wheelchair or a set of crutches, right? You look at any disability insurance marketing piece and everyone's laid up in a wheelchair. And I'm just like, my father, I don't know if we'll get into this, but my father battled cancer for 20 years. He was in a wheelchair for about the last 30 days of his life. And every other day for that 19 years and 11 months, there was no wheelchair, there was no crutches. He just looked like an ordinary person. But when you're a doctor, you're the one operating on a handful of these people. If you're a cardiologist, you're the one installing the stents, and you see how arteries and the human body tends to start coming apart on or is exposed to certain risks. But two, especially like entrepreneurs and executives, that hasn't been as much of a staple occupation until the last, let's say, 20 years. And that's, I don't know if you know, but in the 90s, disability insurance had a really rough ride, a ton of losses. A lot of those risks were doctors. But it was always the thing. If you were an insurance agent, you wanted to go talk to doctors, right? They needed disability insurance the most. And so it's always just been this kind of phenomenon that doctors are always talked to about disability insurance. Then, some of these professionals see enough people go on claim, especially when you have $200,000 or $300,000 in student loans that you're going to have to be repaying over the course of your career. There's a lot of money on the line, not just your future earnings for your personal balance sheet, but also paying back a lot of loans that will not default no matter how many times you claim bankruptcy.
Which I got to say, the thing that's a little bit of an aha here for me that seems to be a bit of a commonality is you have two things that I just hadn't considered before. Number one, both your professional athletes, which we'll just lump that in with celebrity generally, and physicians both have this situation where they're making next to no income or running backward in the sake of a physician borrowing.
Right.
And then suddenly, boom, they just have this enormous increase in income from where they were before. Maybe very much the same B-level actor, commercials, small films, and then something happens and they catch on. Yep. And they have this huge increase in income. And that big pop in income gives them the visibility. Like, this is precious. My body is dependent on it. I need to be able to show up to do this. And then couple that with, especially on the physician side, you are ever present to the fact that these disabilities do happen. And probably in that professional space, you're not as a professional athlete, you're not hanging out with the guys that got disabled from the prior season, but it's super prevalent because everybody talks about it. But if you're an executive or entrepreneur, like, I'm sorry to say, and it's just a little brutal in the way life works, but gosh, the guy who got disabled, who was a executive for some major corporation, or the entrepreneur that had to sell his business at a fire sale because the market didn't cooperate in him trying to sell it, coupled with the fact, forget disability, forget wheelchair, them just feeling like your father, like the symptoms might have just been feeling like you have the flu, but for 20 years, that'll take somebody out. They're not present to it. The executives and entrepreneurs don't have disabled people in their life. People aren't on the ESPN every night talking about who's on the disabled roster, or what do they call it? I'm not a huge sports guy. Injured list. Thank you. Not disabled roster, but to them it's the same. That it brings present to them that they could be in danger of that. That doesn't exist for the executives and entrepreneurs, coupled with the fact that their income climbed over a long period of time. That executive or entrepreneur may be over their lifetime well out earning the athlete, maybe out earning that specialist physician by a lot. But because it took them 10 or 15 years to get there, like a slowly boiled frog, it doesn't feel as special nor as vulnerable, even though by pure definition it is. When you're in the top 1% income-wise, 99% of people would love to have the role you have in society, either as an executive with that newly minted MBA ready to work for a fraction of what you work for and try to eat your lunch, or you're a business owner running a large successful business and there's somebody out there competing with you to try to get that away. And on top of it, your physicality could fail on you due to sickness or injury.
Yep.
Man,
so, Robert,
that's a big aha for me. Thank you for that, Robert.
No matter who someone is, if they're going to look for disability insurance, like, what kinds of things do you recommend people look for in a disability insurance policy?
I mean, it's all down to the fundamentals, and I think you both are very apprised to what a professional needs depending on their occupation. I always look at the definition of disability. That's probably the most critical aspect. But then also, like, what's the future guarantee that policy is really providing, right? At the end of the day, disability insurance is, I hate to think of it like a gamble. It's more of a, do you want to guarantee that your personal balance sheet will hit the goals that you've outlined to achieve over a certain amount of time? And so, definition of disability, right? If something happens to you, you want to make sure that you're actually receiving that benefit.
Yeah.
And then how long that benefit's paying out. I don't think that's quite as important as the actual definition. You know, most disabilities, the average length of a long-term disability is actually only 3 years. So a lot of people look at these to age 65, to age 67 policies that would pay them for 20 to 30 years. And that's probably going to be expensive, where you can actually bring something into your portfolio that covers the heavy majority of some of those injuries or illnesses. And like I said, the most critical aspect would be making sure that you have a policy that has the right definition for your specific occupation.
You know, gosh, what you just said was so huge for me. I never heard of it that way. That a lot of people do talk about insurance as being a bet, like life insurance or disability insurance. Well, I'm just making a bet with the company, but no, it's making a guarantee.
Right.
You're making a guarantee that your balance sheet hits those goals. That's amazing.
The same thing occurred to me is actually, it's not speculation to insure something, we are speculating now. Right now, if you're listening to this show and you don't have any income protection, either through your employer or you are the one speculating.
Already
I'm going to soapbox here a little bit before you take us to commercial, Cory, but gosh, bless it. The perversion that our industry has put on us, like that, hey, you're speculating or gambling. And why? I think largely because the financial institutions want you to buy into speculation and gambling. Sorry, I'm not going to go totally black helicopter, but hang with me for a minute.
Okay. Bring back.
Literally what happens is they want us to buy into speculation and gambling because they want us to go after the active managers. They want us to be able to bet on individual stocks. They want us to open an E-Trade account. They want us to be in Scottrade. They want us to do all these things that are totally speculative. So it's no big deal that disability and life insurance is a quote unquote gamble. And that is utter, gosh, bless it. I almost kept us in an explicit episode this time. But think about this, that they literally have convinced us that we're speculating when the thing that we're doing is we're assuring that our future can be achieved. We're not speculating anymore. How about stop speculating, protect your future?
Mm-hmm.
Wow.
I think that's the name of a future podcast episode you guys are going to see in another 8 or 9 episodes, because I think I could rant on that for like 5 minutes. There's a little future taste of an episode, probably one of them when Cory's out of town and I just am unsupervised.
Looks like I can't go on vacation for a long time until he forgets about that.
That's speculation. When you go on vacation, what episodes will release while you're gone?
I am aware. From ancient shipping syndicates to JLOs took us to active management and speculation. Where will we go next in this episode with Robert Clark? Find out when we come back from this brief message from Sound Financial Group.
Hey everybody, I'm interrupting our show for a really important reason. We have a brand new white paper we're hoping you'll get value out of. Some of you actually might not even need the white paper. You might be ready to talk with Cory or I or our other team members about our philosophy. We'd be honored to do that with you, and it's in your control as to whether or not after that you would want to apply to become a client. We just want to impart more knowledge to you and make you better equipped to deal with the financial institutions and every offer that comes at you. But in the meanwhile, we also have this white paper that we want to get in your hands to help be able to shift the way that you think about money. This white paper is going to show you 3 of the biggest mistakes we see people make and 6 ways to fix those mistakes to get you and your family on the most efficient track toward financial independence possible. You can get that by emailing us at info@sfgwa.com. That's info@sfgwa.com. And we'll look forward to hearing from you soon. We'll get it right out to you. We hope you read it. We hope it opens up your mind and puts you in a position to better be able to design and build a good life. Now back to our show.
Welcome back to Your Business, Your Wealth and our interview with Robert Clark. We went a lot of different places before commercial, and now we'll see where we go. I don't even know what Paul's going to say next, Paul, but you're chomping at the bit to ask Robert a question, so I'll let you take it away.
Sometimes I barely know what I'm going to say next. Robert, we just ended up talking a little bit about how our industry gets things wrong, especially around framing. But when it comes to actually planning for clients, what do you think it is that most advisors get wrong when it comes to this area of just income protection, period?
Yeah. Unfortunately, it's a pretty long list when it comes to this kind of niche space in someone's portfolio. I would say first and foremost is a very easy one. And it's that most advisors out there soliciting this don't actually own a policy themselves. And so I'm a big believer in buy what you sell what you own, right? But a lot of these advisors also think they're invincible. And that comes across to clients when you're trying to talk to them about things like income protection, right? So now all of a sudden, I would say two, you have an advisor that wants to sell the permanent life insurance policy and is like, oh, by the way, do you want a disability insurance policy? And they're like, no, I don't need a disability insurance policy. That'll never happen to me. And the advisor believes it, right? They're convinced because they've sold themselves on the same false beliefs within their own financial portfolio. But then three, we do have the advisors that are out there talking about it, that are educating clients. And one of the shortfalls kind of goes back to the thing that I talked about with benefit period. You buy some of these exorbitant benefit periods, right? Lifetime benefits was a thing that used to exist with disability insurance. And this is exactly why a lot of disability insurance carriers went insolvent in the 90s. The advisors were trying to sell the longest benefit period possible. Well, that's not actually what most people need, especially in a high income space. You can really get away with a 5-year benefit period, maybe have a tax-free lump sum payout at the end of those 5 years. But all of a sudden, we're bringing down the cost significantly. So it's not like we're trying to sell a second permanent insurance product in their portfolio. We're just doing a little risk management to make sure we buy some time to make a well-informed decision if we have to transfer to liquidating other assets or turning more assets into actually some cash flow and income, as opposed to aiming to acquire more. I mean, I'm speaking to the finance geniuses here when we think about, changing someone's equity ratio and actual risk in their portfolio to something that's probably more stable and can provide a sustainable amount of cash flow. So those would be my three go-tos.
So one of the biggest that stands out for me is the advisors themselves not having their income protected. That is huge. And I totally understand what you're saying. Like when we talk to our clients, say, about investing, and we're like, this is exactly what we're showing you is exactly where our money is. It's meaningful. And when it comes to protecting income, if like in the back of our head is the little bird that's like, well, we never pulled the trigger on that, what are the odds the client will? And I've even gone so far as to see the quote unquote fiduciary advisors that you guys have heard Cory and I talk about on the podcast before, where they're fully fiduciary except for anything that would inconvenience them, like bringing up disability insurance, and they have literally will put something in front of their clients. Would you sign this just confirming that we talked about disability insurance because I don't want the liability? Like, wait, the client is signing a form to say that we talked about disability insurance so that you can relieve yourself of the liability while not relieving the client of the liability on their balance sheet of what if my income stops. But specific to Petersen and Lloyd's, let me ask, Robert, what is like the ideal candidate who should be looking at, say, Petersen, Lloyd's as a source for coverage, say, versus the regular disability insurance contracts that are out in the marketplace?
Yeah, absolutely. So Lloyd's helps with any client that wouldn't fall into a traditional life insurance disability insurance need. And really that's defined as, most individuals making, let's say, less than $300,000 a year, they're taking home about $15,000 a month. A lot of the traditional disability insurance carriers will offer policies that get them up to full income replacement. So Lloyd's target market, just like the entertainers and athletes, we're really looking at people 300, 500,000, even up to $2 and $3 million a year of earnings. That's really who Lloyd serves best from a disability insurance standpoint. Because like I said, they're basically corporate athletes of the world, right? We have a significant amount of income on the line, and so we need very large contracts to protect that individual.
What about someone who may be making more, like the $200,000, $300,000, $400,000 a year of income, but they have conditions that the regular companies aren't willing to consider? Is there some slices that Petersen is looking for there?
Exactly. So I'm really glad you brought that up, because there's a number of substandard. I don't want to call them substandard, but clients. Here's a frequent call we get. I have a client who just found out that they have stage 2 cancer, right? Whatever the case is, but they went in for their physical. They found out on the labs or that their health might be not as great as they were expecting. And so that's the time that they're trying to acquire disability insurance. And yes, that is a market that Petersen helps with. But also outside of health, there's a lot of occupations that most insurance carriers don't want to touch. Professional pilots is a perfect example. The athletes and entertainers, that's why they fall into Lloyd's world as well. So anyone substandard, whether that's some pre-existing health issues or just a very risky occupation, right? Skydivers, male entertainers, you name it. And that's where Petersen picks
I
up.
just thought of someone that I need to introduce you to.
If that's what triggered it, Cory, good night. Well, I got to tell you, I'm just so glad that our weekly show is jumping the shark with you, Robert, more than anybody else.
Right. No, I do know what I wanted to ask you about, and I'm going to try to ask this without any kind of industry lingo, if I can help it. Can you talk about the type of disability insurance that a company can get or an owner can get for their company on all their executives, usually without any kind of underwriting?
Yes. So this has been a staple in the corporate C-suite space, but also large health centers and large law firms. The thing that makes it very attractive to do by acquiring a disability insurance policy from a multi-life, there we go. I use the industry jargon word.
Okay.
So instead of insuring one individual, we're actually taking them and maybe, let's say, the 6 or 7 colleagues at a similar income bracket and offering a policy to each of them, still completely individual. But to your point, Cory, there are so many benefits to doing this as a multiple life application. Like you said, they're getting out of all the medical exam requirements. For Petersen and Lloyd's, there's actually no health questions too. It's a full guarantee issue policy. And then on top of making it that much easier to get, we're also discounting the premium. So basically, a disability insurance underwriter, if they insure one person, that's pretty high risk. If they can now spread that risk out to 10 or 20 people, they feel a lot better about accepting the right amount of premium for an expected amount of loss. And so that's how they can make it so much more advantageous for a client.
It's so good. Well, and one point of refinement that I want to have there for our audience, as I heard you two go back and forth, is the idea of that individual disability insurance contract has individual language, unilateral contract, meaning as long as you pay your premiums, you're the only one with control. The insurance company cannot change a dot on an I or a cross on a T from what it says. Whereas your group contracts oftentimes will have a provision that your employer pays for it, which is very nice of them, except if they're paying for it, if it's part of the group contract, then sometimes as little as 30 days notice, they can change everything about your benefits and coverage, and it's not portable. So when Robert mentioned that portable piece, it's really key that as much of your coverage be yours as you can, so that it's not attached to the company you currently own if you're the entrepreneur, or the company that you work for if you're the executive. Because we have clients we work with all the time who have been on group for years and years and years, and they're getting ready to spool off and do their own thing. And yet life has happened. Medical events have happened that put them in the position now that they can't really secure traditional coverage to protect their income, to take, as we mentioned earlier, speculation off the table. Yeah, Robert, absolutely. I'm super thankful you could be here. This is just a great conversation today. Certainly a lot of fun. We talked about some things I didn't think that we'd talk about, but
that's for sure.
Yeah, just love that you were able to come on and share some of this with our audience. So thank you again.
Absolutely. Thank you both for having me. I really appreciate the opportunity.
Yeah, you're welcome. And for all of you out there, as you listen today, here's what I would have you just focus in on, or most take away. Number one, that when we own appropriately secured, properly thought out insurance coverage, we're not speculating. You're taking speculation that everybody else is accepting by default off the table. Being able to take a look at what are your future goals and plans, what's really important to you and your family. What are those things that about your sufficiency, the future that you want to have, that cannot be compromised, that you would not want to have compromised, that you would fight for? Because the problem is we don't get to fight the same way if our bodies break down. We don't get to fight the same way if an accident occurs. We don't get to fight the same way when we're sick. We just have to have the decisions that we made prior is all we get to lean on. And making sure that we're properly protected in the areas of disability insurance, life insurance, or even simple things like our umbrella policies. Do we get permission to actually be in a spot where we get to make the choice about how our lives live out? Unfortunately, we don't get to make that choice in the moment. Sometimes that choice is made years before. Sometimes some of you listening right now are making that choice as we speak of, I've got to get some of these things handled. We're always loving hearing from you guys, so don't hesitate to reach out to us at info@sfgwa.com. And please take a moment, go into your iTunes app, hit the rating button. We would encourage you to give us a really great, honest rating, because when you do, it improves the iTunes feed. It's going to get this on somebody else's radar who you may never meet. But we're now actually hearing from people who literally heard about the podcast because somebody shared it on social media, because of the ratings, because of the downloads, whatever it is that's getting their attention. Those of you who have been loyal listeners, who are rating the podcast, who are sharing it on social media, you are making a difference for other people. With that, if you do make a podcast review, take a screenshot, email it to us, and we will send you a copy of either my book, Sound Financial Advice, Cory's book, Cape Not Required, or we still have a few copies left of Michael Michalowicz's Clockwork that we would love to send you. We're so glad you could join us today, and we hope that this episode has been a contribution to you being able to design and build a good life. I hope you enjoyed today's video. Thanks for watching. Be sure to subscribe to our channel, ring that bell, and by the way, make sure to share this video. I don't know if you know this, but my cyborg body runs 100% on YouTube views and likes. Please don't let our batteries die.